Hello, everybody. Good afternoon. We'll give everyone just a few more minutes to jump in from the waiting room, and then we'll go ahead and begin. All right. Good afternoon, everybody. Thanks for joining us for today's webinar, Valuation Trends of IT Companies for quarter one of 2025. My name is Aaron Mahl. Delighted to host the webinar today with Greg Northrop, our Director of Tax and Finance at iTValuations, and with Reed Warren, Founder and CEO of iTValuations. Thanks so much for jumping on. You might be right now fully giving us your full attention to this webinar. You also might be watching March Madness. We're not sure which one, and we're not going to judge you regardless. But if you've been to our webinars before, you know that we like to give away an Amazon gift card or two if you can answer the trivia question correctly. And so this trivia question relates to March Madness, and that is who did Greg pick to win the men's 2025 NCAA tournament? The first person to correctly put that in the chat and submit it will win the Amazon gift card.
There's only so many options though. It's not an
68
infinite pool.
Yeah, 68. I'm going to give you one. I'll give you one quick hint, which is the team is still in it. So he did not choose Louisville or High Point. Those are not the correct choices, but and I'll be honest, when Greg told me this is another hint, I'm giving it away too early, but I was surprised. I had not heard of a single person who'd picked this team yet, and so there's your hint. If you were on the webinar early, you know you have some additional insights. So if you could drop that in the chat, and I'll bring that up again probably about 15 minutes in for those of you who arrive a little bit later. So who did Greg pick to win the 25 tournament? Reed, did you pick anybody? I'm curious.
I have not had a chance to watch, so it's
that usually means you'll win. You know. Yeah, it's
I was originally rooting for Louisville, but I can't even say that anymore. So, you know.
Exactly. Well, just a couple quick housekeeping items before we jump in. We'll be at the Evolve quarterly meeting as well as IT Nation Grow in May in Chicago. And so if you're going to be at those events, Greg will be there, Reed will be there, Corey Kearns from our team will be there, and I'll be there. So a few of us will be there. Happy to connect and meet, talk through any valuation needs, CPA needs you might have. And the IT Nation Grow event is a great event that actually walks through M&A. And so, Greg, I know you've been at a couple of those. Maybe give us a highlight of what that event's like for those who may not be familiar.
Yeah, I mean, the IT Nation Grow is really a four-part series, so no two quarters are exactly the same in terms of what they cover, but it's really meant to kind of give you insight into that M&A journey. What is it like to go through an acquisition or potentially sell your business? And what are some things you can be doing now in preparation of doing that? And it's amazing when I talk to owners about all the different insights that come from that of like, wow, I didn't think that I should be doing that, or I didn't realize that I had all those steps. And it makes you just appreciate the people that do M&A for a living, and really gives you insight into what you don't know, so that you can really make educated decisions as you walk down that journey. So it's been a really powerful session for folks, and very enlightening.
Yeah, that would just, if I could just jump on as well, Aaron. I know in the from the last one, I got to be part of the Evergreen Elevate event, and that was really actually good. It was the first year they did that. Really brought in some great guest speakers. I mean, not because I was one of them, but there was a really good selection of speakers, really talking everything from leadership, how to manage people, boss versus babysitter, which was put on by the CEO of New Charter, which is highly recommend if you have a chance to hear him. Just really good tactical information about how to lead a team, how to be able to manage teams. So great event at Evergreen's Elevate, and then also previously at the Robin Robbins event here in February. And again, just it's so refreshing to have. I know there's a lot of different components and there's a lot of different groups that we can be involved with as MSP owners, but just really looking at, just loved what Robin Robbins is doing around just how to create a differentiated service offering, go-to-market strategy, good sales tactics of how to organically grow your business, which is one of the key, drivers of value. And I think, if I'm not mistaken, Aaron, Robin's going to be on with us here coming up.
Yes, great segue, Reed. It's like you're paid to do that. We actually we do a couple webinars a month, and we're pretty excited about. We have a great quarter two lined up. These are just 3 of the 6 we're going to do. There's All of our webinars are available at itvaluations.com/webinars. But we'll start with the April one, the Value Driver series. So obviously, our valuations look at 24 company-specific risk factors. Some of those are financial drivers of value. And so we've asked our friends at Next Level Now to help participate in that webinar and talking about those drivers and how they can help you understand and grow your business. In April, we have the avoiding the tax surprise for the next year. And so some of you have wrapped up taxes for the current year, but some of you are not done yet, and that's okay. But regardless, is how to avoid the tax surprise in April. And then the growth and marketing one that Reed's talking about is with Robin Robbins on May 29th. Those drivers of value will unpack at a greater level of detail. So excited about the content that we have coming up for you, and that lives evergreen on our website. And so you're always able to, if you missed a webinar, you can go back and check that out. So, but let's dive in to our topic today, which is around the trends we're seeing for 2025 Q1. A quick note for those of you who may be new to us, iTValuations is a business transformation company that really happens to do valuations, buy-side, sell-side advisory, some merger work as well. We have a CPA firm called IT Tax Advisors. For any more information about any of those services, you can scan the QR code and we'll follow up with you after the event. Mm-hmm. So now let's talk about drivers for what we're seeing in 2025. Multiples in their trends are certainly driven by the company-specific risk factors that we see. We've discussed those on previous webinars, but I'd like to start with the macro level because those are often factors that influence valuations in multiples that are really outside of the control of those who run maybe an MSP. So Reed, I wonder if you can talk about some of those external factors that are playing a role right now in M&A and how they're impacting multiples.
Yeah, certainly. I think one of the ones everybody wants to know, interest rates. And yes, interest rates impact values. That doesn't surprise people, but I don't think people realize oftentimes how much the interest rate actually can impact the valuation of the company. And so, we've had the, I don't want to say luxury, but it is a luxury coming off of the COVID years where we had some of the lowest interest rates in history. And we definitely saw that really fueled the acquisition markets or transaction markets for getting transactions done. We're on the other end 5 years later from the lowest point in history to one of the higher ones, certainly in recent history. You have to go back to the early 80s for those of you that might have been alive in the 80s. For those with webcams on right now, I'm probably the only one that was alive in the 80s at that point. We're seeing certainly one of the high points that's there. And so when you look at it from a multiple perspective, so when we see interest rates shortly after COVID and through 2021 that were right around 0 or at 0.25% to right now, when we talk about risk-free rate, it's basically the U.S. Treasury bond is what's considered the U.S. as considered the risk-free rate. It is the highest probability of return. It's effectively guaranteed, and unless we can always debate it, unless the U.S. government goes out of business, it's the safest bet, lowest risk, and still get a rate of return. And so the 30-year Treasury bond tends to be the measure of that. That said, we saw that super low in 2020, 21. Today we're seeing it at 4.6%. So one of the highest it's been certainly in recent history. And a lot of people go, great. So what does that mean for the valuation? Well, so from an impact perspective, if we, all things being equal, if we took this slide and said the interest or the risk-free rate was 0, you would probably have something closer to a 5x multiple. If you, something closer to a 9x multiple. If you take this same number and make it 4.6, you might have something as low as a 5 to 6x multiple. And so in the end, the difference of that risk-free rate going from 0 to 5% can have as much as 3 multiple turns when it comes to the valuation of the business. And so I don't want to get lost in it, but in the sense, hey, as we look at the risk-free rate, equity risk premium is, hey, the difference between publicly traded versus privately transacted. Obviously, a private business, your money is not as liquid as a public company. Size makes a difference. There's a size risk premium that varies as well. Obviously, the larger firm is more predictable, higher probability of success than the smaller firm. And then we have industry risk premium. So all of these are risk factors that are being, and I'm going to call them external risk factors because you don't control the industry to a large extent, although you can influence your size. It's not going to radically change. And the equity risk premiums are also pretty much dictated for you. And we watch the risk-free rates change. In short, all of those dramatically impact the overall transaction value. At the same time, they don't change that fast. So we've gone through probably the highest rate of change between COVID years and now from a risk-free rate, but it's probably not going to go higher. It's going to start to retrace, and the Fed has already started to announce some of that retracement. We see that when we look at a lot of the mid years, we typically see stuff that's in that 2 to 2.5% is really common, and I expect that to get the risk-free rate to get back to those levels within the next couple of years, and probably continue to operate in the 2 to 3 range is pretty much the historical norm. Equity risk premium, that's continued to stay pretty steady. Size obviously changes based upon how large you are. Industry risk premium has shifted a bit from being negative. Actually, for a while, I think it was actually negative during the COVID years because the industry, the IT services industry, is so much the bread and butter kind of industry in the US. Every business needs infrastructure and technology that it actually for a while had a negative risk premium. Today it's up a bit and impacting the value of businesses. All that said, the IT services industry continues to be one of the lowest risk industries in the US. So all of those factors are sort of outside your control, but they definitely do impact the value of the business.
Yeah, the impact of the cost of capital obviously impacts buyers and sellers in some ways similarly but differently. Greg, I wonder if you could talk about these external factors and how they're impacting sellers from what you've seen.
Yeah, I mean, one way to look at this when you're looking at even just the rates that we have here on the screen as kind of our example here, Reed touched on all of those really risk-free rate of return, equity risk premium, industry risk premium are the ones that really have they're like independent of who you are as a company, whereas size risk premium, company specific risk are tied directly to the size of your company, who you are, what are your risk factors. Then the other one independent risk factor that's mentioned there is the long-term growth rate in the industry. And so that dictates, okay, what is the kind of almost like inflationary rate within the industry. And so when you're looking at all of that capitalization rate down at the bottom, that 20%, what does that 20% mean? Well, that's effectively, if you divide the 20% into 1, it's effectively a 5x multiple. That's essentially what you're getting there, 5x multiple on historical earnings. So a lot of what we've been seeing for sellers is even on the low end of, MSPs, we really have been seeing kind of 5x become the new floor. Not to say that you can't go below that, because as we've talked about with that company specific risk size, with risk premium, some of those factors are dependent on the organization. Those percentages could be higher depending on the company, but there's been a lot of movement towards, companies being able to sell for at a minimum that 5x on the low end, and then having it scale up from there. So then when we're talking multiples in the marketplace, you're actually seeing companies that are really have very low risk factors, that are really well put together, high operational maturity. That's where they're able to get these higher multiples, is that as they get bigger and bigger and are more operationally mature, their size risk premium goes down, their company specific risk typically goes down. In turn, that discount rate and capitalization rate go down, which then in turn allows buyers to pay more for them because it's a better return on investment for buyers. So that's really where this impacts sellers, is as these rates move, that's having a direct correlation on what you can reasonably expect from a transaction.
But even with, just if we can talk on some of the macroeconomic factors here for just a bit, even with there's concerns, what happens if, whatever, war with China, or, things way outside our control. Hey, if there's when you look at going from a 20% to a 25% move in the marketplace, that's a 5% point here in a cost of capital, that's about a 20% movement in the overall market. If you have a 20% movement in the overall market, you're still talking only about one turn, right? And so a lot of people are like, well, should I sell now because, something bad could happen, this fall. Even if something bad happens, we're not talking about this radical, you're talking about, and I realize if you have, 500,000 EBITDA, one turns $500,000, you make, oh, that's, that's a lot. At the same time, you're saying, hey, if I was going to be valued at 2.5 million or 5x multiple on 500,000, and the catastrophic happens, we go to war with China and the market plummets a total of 20%. Hey, well, I went from a $2.5 million offer to a $2 million offer, right?
Right.
And so I just want to bring context to that. The whole idea of trying to time the market, you're better off focusing your energy on what you can control, because what you can control within company specific risk, and we'll talk about that in upcoming slides, actually has more, you have more control, and you have the ability to more dramatically change the value of your business with the company specific risk factors than with the things that are outside your control, which is the other factors.
Yep.
Yeah, Reed, these factors obviously impact buyers as well. So I'm curious,
Yep.
From a strategic buyer perspective, maybe an MSP who's looking to acquire and a private equity buyer who's looking to acquire, how are these factors going into their calculuses when they think about how to value a company and what to transact for?
Mm-hmm.
Yeah, we definitely see that for, buyers across the board, for both strategic buyers and private equity buyers. The biggest thing there is there's less room for error. For the buyer, the multiple is really a secondary factor to the internal rate of return. How do I get my money back? And so from a buyer's perspective, they're going to look at obviously these cost of capital analysis, plus also consolidations and synergies and everything else. A buyer is looking for a rate of return that's going to be greater than ideally your 24%. They're looking for ideally 25 to 30% internal rates of return. What does that translate to? 3 to 4x multiple, right? And so buyers, when you start looking at, hey, how do I pay for 11, a 10x multiple and stuff, I've got to do that through a lot of other levers to be able to get that same internal rate of return. And so that's where you start looking at some of those as a buyer, I'm looking at those company specific risk factors of the sellers to be able to get there. Otherwise, I'm really stuck at a 3 to 4x multiple. Candidly, from a financial perspective, based upon the overall marketplace and market factors. And so we definitely saw during the 2021, 22 timeframe, when cost of capital was really low, your risk-free rate was low, your industry rate was low. During that time, you did have the place where the buyer could definitely pay more for the business because the cost of capital was so low. Today, the cost of capital is relatively high. And so as a result, it puts a lot of pressure actually on the transaction and on the buyer to analyze the seller and to get really clear path to how they're going to get to that rate of return. What are they going to change within the seller's business to be able to drive that internal rate of return? So I have to have those consolidations. I have to be able to cross-sell and upsell. I have to have AI or automations to drive my overall cost of the business down so I can get to that rate of return. And so we've seen, particularly, and we'll see on some of the upcoming slides, from a transaction perspective, yes, they're still paying premiums for healthy businesses, but candidly, if you're not a really healthy business, I can't afford to pay as much because the risk is just too great to be able to do that.
And I'll just add too, on the cost of capital side of things, when we're looking at private equity buyers versus strategic buyers, a lot of times strategic buyers are going to financial institutions, banks, other third parties to get financing to go do those transactions, and financing is really expensive. You have a really high interest rate, so that right there's already an inherent higher cost of capital. But the same also exists for these PE firms. I worked with a number of PE firms in my prior life at BDO, but when we would set up a fund, those LPs that were funding the private equity fund, they had a guaranteed rate of return somewhere between 8 and 12% on their money for whatever duration the fund lasted. And it was a compounding 8 to 12% per year. So when you're looking at that, that's literally no different than the cost of going out and financing, from getting a loan from a bank for a strategic buyer. So both sets of buyers are under the same cost of capital constraints because where they're getting their capital has a similar kind of interest component tied to it, which makes that capital more expensive to Reed's point. So I think it's important to know that same thing exists for PE as it does for strategic. It's not just free money that they have.
The important thing to remember, though, for both strategic buyers and PE buyers, and PE buyers definitely get it. So private equity acquisitions are definitely leverage buyout. I just want to be really clear on that. And they're leveraging typically 30% of their own money is what they're putting into it. They're typically debt financing another 40 to 50%. And then we have the seller has 20 to 30% rollover equity. In the end, they're only going out of pocket for 25 to 30% of the total consideration. So it's considered a leverage buyout to be able to do that. Part of the reason, and a lot of people are adverse to taking loans, and I get that, and they're adverse to paying interest rates. But the reality is this: debt is never multiplied. EBITDA is multiplied. And so when you look at a private equity firm, they're going to borrow money to go buy a bunch of EBITDA, in short, through doing these acquisitions. The value of that EBITDA is continually multiplied. And as long as the multiple on the EBITDA is growing at a faster rate than your interest rate is, which it should in every situation, you now have this way that says, hey, I may spend $10 million to buy $30 to $40 million of value. In the end, I only have to pay the $10 million back when I sell the business for $40 million, right? So just understand that there's a yin and a yang to the whole interest rate expense piece, because there are times where it may make sense to go get mezzanine type financing, which you go, why would I pay 15, 20% interest rates to borrow money to go do acquisitions? Well, if I acquire the right profile of company and the right seller, I can now get to an 8 or 9x multiple on the EBITDA I just bought. And yes, I paid a pretty high interest rate, but I have a means to be able to pay that back and still harvest the growth of it.
Yep.
For those who may have joined us late, you're seeing some random states and schools mentioned in the chat. Those are trivia guesses about Greg's March Madness men's champion prediction. I will tell you that I did a quick glance and no one has gotten it right yet. So for the first person who can correctly identify Greg's March Madness champion, you will win an Amazon gift card. So drop some more guesses in the chat. Greg, I want to kind of shift a little bit to valuations, and we're going to show some transaction data. But before we get to the transaction data, you're doing obviously valuations every quarter for many of our clients. Well, how are these factors impacting valuations, and any trends you're seeing really early on here in 2025?
Yeah, I mean, when we do our valuations, we do an income-based approach followed by a market-based kind of like true-up or analysis to see, does that income-based approach truly hold up in the open, market if they were to go to market and sell. And when we're looking at that, we're actually seeing a really close parallel to what these interest rates are producing from an income-based approach to what we're seeing in the market. And if anything, we're even seeing the opportunity to potentially raise some valuations on some of the future cash flows, just because companies that have really low company-specific risk are able to stretch those valuations maybe a little bit higher than they were able to do in the past. And that's where we're still seeing, pretty healthy multiples in the marketplace, both on valuations and in transactions. But there is a extreme difference between a company that is, operationally mature, fully functioning, very low company specific risk, and one that is not. And so where we've seen maybe a really big disparity in our valuations is those companies that are $3 million and less in revenue. Those valuations, I think generally across the board, everyone I've done, the seller is very disappointed in their value, because it's not just a plain 5x multiple on EBITDA and that's the value. If anything, it's a lot less than that. And there's also a lot of conditions that are put in place upon that transaction if they're going to transact, because it's not as simple as just here's 60 or 70% cash down. There's going to be a lot more contingencies, earnout, or conditional components to the deal in order to make it work because of the risk factors that exist, versus companies that are on that 5 to 10 million in revenue or above. That we're seeing a lot more of a streamlined, like easier valuation process aligned with the marketplace, just because those companies are few and far between in terms of the really operational mature healthy companies, and buyers are looking for those all the time. So yeah.
Well, I think we do have some great examples there, Aaron. And if we move into it, ones, and they're actually, it's a little bit larger one, and so the companies in the top, I just, well, kind of highlighting some of the ones here in the first quarter of this year. These are close to being consummated. Let me just put it that way. Apologize for that. But when we take a look at, some of the ones that we see, like in coming up here in April, we're seeing, healthy business from a revenue perspective, 2.7 million in EBITDA, but we're looking at a multiple on EBITDA of 7.6. And if we look at the one that's happening in March here, that's we're on final glide path to close, getting close to a 14 or a little over 14x multiple on 2.4 million EBITDA. Both great case studies of one has great organic growth, been growing at a compound annual growth rate. Obviously, it's the lower one at the higher multiple, but they've been growing at close to 28 to 30% year over year from a top line perspective, while sustaining 18 to 20% on the bottom line through that whole journey. Great contract lengths, typically dealing with 3-year contract lengths, low churn, solid leadership. In contrast, the one here in April, they kind of assembled together a number of acquisitions, and the financials weren't super clear, and so the buyer was concerned about organic growth rates and consistency of the EBITDA over time. And so again, it's very much a polar kind of scenario, but those company specific risk factors are dramatically impacting the outcome and the transaction value of the two businesses.
Mm-hmm. Yeah, Greg, what would you add? I know you're familiar with some of these deals too and the trends over time. What would you add to this table?
Well, I mean, going through kind of like just like Reed was touching on, the company specific risk differences, specifically like when you're looking at, no two companies are the exact same, even if their numbers are similar, the risk profiles are vastly different. And a lot of times the risk profiles are not just financial. That's why when we look at our 24 risk factors, we're looking at both financial and non-financial risk factors, because that's what's taken into consideration in a transaction. A buyer is going to look at your set of risk factors and come up with their own company specific risk assessment of your company. And if that risk assessment comes back high, you're getting a lower multiple, and you're going to end up potentially having different conditions or contingencies put in the deal as well. Versus if you have a really low risk profile, that's where they're willing to quote unquote overpay. And it's really, I mean, even the concept of overpaying, like if you look at that deal getting almost a 15x multiple on 2.5 million, you might look at that and say the buyer might be overpaying for that. But if the buyer knows that that's a growth engine machine, and they can now take that and then turn that 2.5 million in EBITDA, 14, 15 million in revenue to like 30 million in revenue and 5-6 million in EBITDA, well, then it's totally worth it, right? What can the buyer do with it, with the organization, that really drives the transaction values. So we're just even seeing that on a valuation front of like the disparity from a company specific risk standpoint. Our company specific risk is rated from a 1% all the way up to a 10%, 10 being most risky, 1 being the least. On average, we only see company specific risk rates between 1.6 and 7.8 be on the high end. Like the lowest I've ever given is 1.6, 7.8 is the highest. The average is somewhere between 2.5 and 4. But that disparity between the 1.6 company and the 7.8 company, that's over 6 percentage points. That's more than a turn and a half. When, Reed was talking about EBITDA turns, you're almost getting up to almost 2 full turns on a difference in your EBITDA multiple based on just simply your risk profile. So that's why, coming back to, Reed mentioned it earlier, focusing on what you can control. The macro factors are going to move so slow relative to how quickly you can change your internal risk factors. And that's really where we want companies to focus their time, because that's where you can increase the most value.
Yeah, I think the most frequent question we get maybe is, what are you seeing on multiples for X EBITDA? And we always hedge when we answer, right? Because there's so many factors that go into that. And I think this table illustrates that at some level. If we just took the average multiples at a certain revenue range on this table, then we would be probably undervaluing one company, overvaluing another one pretty dramatically, right? And so I think that's why there's so many factors that go into this. So by the way, still no one answered Greg's question or Greg's trivia, right? So again, there's 68 options, and the teams that are still in it, the one he chose is still in it, so that's good to know. So if you're the first person to get his NCAA champion prediction right, you'll win a gift card. So I think I
did see that. I did see the question that kind of came through while you were talking there, and I just want to touch on that. because yes, deal structure does make a significant impact on the valuation or the transaction value. So I want to touch on a couple things here. What we're looking at here is transaction data. And if you were listening to us, you're like, well, if the company specific risk factors could have as much as a 2x turn on the value of the business, I'm seeing more than a 2x turn between 7x multiple and 14x multiple. And you're right, absolutely, because this is looking actually at transactions and what a buyer is willing to do and what a seller is willing to do. And the deal structure has a huge impact on that. So when we look at the more profitable one, yeah, we're looking at something that's a 60% cash, that's has 20% rollover equity and 20% seller note, which is a real typical deal structure for a private equity backed firm. We see typically 60 to 70% cash with 20 to 30% in rollover equity. We're looking at something that's a 60% cash, that's has 20% rollover equity and 20% seller note, which is a real typical deal structure for a private equity backed firm. We see typically 60 to 70% cash with 20 to 30% in rollover equity. And so there's some moving parts on it. The more that's deferred obviously becomes more performance based. And so there's an upside for that, but there's also additional risk with that. We are seeing more and more today, I would say performance-based payouts are becoming a more important part. That a lot of times people equate that to earnout. There's earnouts. Yeah, I don't want to get lost in that, but fundamentally, you got to drive the business. The business has to perform to be able to get to those returns. So I would say deal structure in general tends to be 50 to 60% cash at close, with the remainder being a performance-based or somewhat risk-based or deferred payout in some shape or form. The greater the risk in the business, the lower that cash number becomes. Conversely, and we do have a couple in here that maybe more back in the 22, 23 timeframe, where we were seeing higher cash amounts. Typically, the cheapest way to buy a business is with more cash, less deferred payment if you're the buyer. For that to happen, the buyer's got to be very, very confident in the low risk profile of the seller to be able to pull that off. The result of that, though, is you end up paying a lower multiple. And so it does pull down the multiples to have a higher cash value for the business. So there is definitely an even trade. Again, the more that's cash based, the closer to that 5x multiple everything really ends up becoming, because in the end for the buyer, I really can't afford to pay more than I have to get at least at a minimum a 20% internal rate of return. If I give you an all cash transaction, my limit to that is pretty much a 5x multiple to be able to make that happen. Sometimes I can stretch that a little bit because I feel like you can do a lot with the business. So that's definitely a real consideration when you take a look at selling your business.
Yeah, and I'll just add too, some of the transactions that aren't depicted here are maybe some of those smaller like tuck-in type deals, like $2 million and less in revenue. And that's just mainly because we don't, those companies, if we were to represent them from a sell side, are maybe a little bit lower than our minimum fee. And so that just doesn't financially make sense to do those transactions, but we're still like loosely a part of those conversations and part of those transactions. And what we've seen on the lower end, as you go down in size, the risk factors generally scale up because customer concentration generally is an issue. Owner dependencies is generally an issue. You potentially have, recurring revenue, and MRR is potentially an issue, and maybe a lack of contracts is an issue. And so because all those risk factors are just greater, the smaller the company, we see a lot more deferred payment from, kind of percentage wise. I know we said 50 to 60% cash up front on our average deal. We could see as low as 20 to 30% cash up front on some of those smaller deals, with more being deferred, just from the standpoint of we really need to see the business transact and change hands to the buyer for the buyer to feel comfortable based on how high the risk factors truly are on a company of that size.
That's great. So one final question, then we'll get to the winner of the trivia question and a few closing remarks. By the way, still don't have a winner yet, so I'm just trying to extend it a little bit longer. Yeah. Sam is trying, man. He's going through the bracket typing things out, but he hasn't hit it yet. So So at a high level, Greg, advice for sellers, read advice for maybe strategic buyers in the space, kind of given these factors, given what we know, what would you say?
Well, from the buyers, it's going to come down to as much as we talk a lot about multiples and the pieces like that. For a buyer, it's the probability of success. So when you think about the risk of success, in fact, I was talking with a gentleman today who was interested in buying a company. I was looking through the seller's financials. Overall, he's struggling because he feels like he's going to be paying a premium. The reality is, pay the premium if it's low risk because I can get to my return. So it really comes down to, in his situation, looking at does the culture of the seller align to my culture? Or would I actually, one of the test questions from a cultural fit perspective, would I hire the seller CEO to my team? If the answer is no, you shouldn't buy the company. That's a great indicator of the cultural fit. As the leader leads, the business follows. And so if you can't get along with the personality or the individual that's the CEO, I'm going to tell you the cultures between your two organizations just aren't going to align. From there, it's looking at the customer contracts. What's the probability of the customers transitioning? Looking at the sellers, really looking at the seller's employee base. Are they used to accountability or not used to accountability? Especially in the smaller firms, it's like, hey, I just got a team. I don't know what they do, but the customers are all happy. Well, if I've got a team if the seller has a team of low accountability type individuals and I got to put them into a high accountability structure, i.e. we're tracking our tickets and ticket response times and customer satisfaction scores, and I expect them to be tracking all their time and so we can track customer profitability. I'm just going to tell you, you're going to turn most of those sellers staff because they're just not used to that level of accountability. So there's all these other factors that are well beyond the financials that impacts the transaction significantly, that as a buyer you need to be looking at. If you can answer all those questions and go, man, I've got a great seller, they fit well, their team is used to accountability, their end user rates align to our end user rates, they have great customer satisfaction scores, then as you see in the data, pay a premium because that's a low risk situation. And even though I may not get, I may pay a 6 or 7x multiple on it and struggle with my internal rate of return, the probability that I can hit it is so much better than if I take a cheaper high risk scenario, which in today's market, you could end up churning a lot of either from an employee base or a customer base or any of those other factors by not being able to address it. So from a buyer's perspective, I would say today's market is less about the financials, although it's really important, and more about all these, the intrinsic value of the transaction than anything else today.
Greg, what would you add for sellers?
Yeah, I'll just
Advice?
answer the one question I saw in the chat. The F in the chart is for an F reorg. So a lot of the companies we help represent and sell are S corps that are then essentially going through an F reorg, where they essentially create a brand new S corp, drop their company down below as an LLC, and then sell the units of that LLC in a stock transaction as taxed as an asset deal. And happy to go into more in depth on that separately if you would like.
But most of those, real quickly though, is so
Yeah.
that the rollover equity doesn't become a taxable event at close.
Exactly.
That's the primary driver on that.
That's the reason. Yep.
I think Greg he's been asking me if he can do a 90-minute webinar on the F reorg, and I've told him no. So but he took the bait. He was going to go for it. So
I was about to. Yeah.
I know we're getting close. We do have a winner, by the way. Reed, I know we use the IBIS World Report. For those who would like a copy of it, we're happy to provide that for you. Just scan the QR code, fill out the form, and we'll email that to you. Reed, what would you add about maybe the value of this report for an MSP owner?
Yeah, so I love this report. We actually subscribe to IBIS World Report, so we can actually give out a copy of this report. The report is about $2,500 if you were to buy it on your own. We tap into this for our valuation work and also for any sort of market analysis that we do, because we can get into figuring out, hey, what's the target profile for the industry and what you can command from a rate perspective on some of those verticalization strategies. So we use IBIS World a lot for that market analysis. This one specifically is about the IT consulting industry, which MSPs are a part of that. Gives you just a great overview of what's happening in the industry, what are key driving factors, what is expected organic growth rates from the market as a whole, as well as what are competitive factors, how is offshoring impacting the marketplace, what are trends that are happening in the marketplace. And so from a just a great overall perspective of those macro factors that are impacting value and impacting where the industry is going. We really like the IVAS World Report. It's a very comprehensive report. It's about 40 pages, all said and done, and it looks at really all these kind of macroeconomic risk factors that impact valuation. So we like it for those reasons, but we also just found that it gives you a lot of really good tips and insights, as well as to how do I start to navigate these pieces? What are some trends I need to get on top of as a part of that? And as well as taking a look, there's a lot to like about the IT consulting industry. We're in it. I realize you probably aren't going to go switch into some other industry. But all that said, there's a lot of really good things to say about being a part of the IT consulting industry from a risk profile. So this report, we're happy to send it to you, and a lot of good information that you'll be able to glean out of it.
Yeah, you've heard us talk a lot about the 24 company-specific risk factors and the valuation drivers. If you'd like to see that the service we offer live, you can request a demo. We'll be happy to walk you through it in about 15 minutes or so and talk through what that might look like for you. So last but not least,
and can I touch on that real quickly with that?
Oh man, sorry. I went too early. Go
ahead.
Yeah,
you went too fast. But one of the things that we were talking today about the differences in profile between top and bottom, I think one of the things that I really like and was such a thrust behind creating the valuation service tool is we can take a look at your company specific risk factors and actually run the scenario and said, well, you might be at I'm just making this up, but as a 7x multiple. But if you fix these things, what would a fixed business look like from a low risk profile, and actually play with those risk scores? And so you can actually run that. You don't have to be the guy that was at 2.7 million, finding out that his best case scenario is a 7x multiple on the business as he's trying to sell it. You could be the other guy that does have it all figured out and can be getting a 14x multiple. All of that comes down to understanding your specific risk profile, and valuation of service actually allows you to be able to look at that and actually play with those risk factors to see, hey, today, what could I do and how much would it actually change my valuation if I had these things fixed?
Thanks, Reed. That's awesome. Greg, defend your pick. Why St. John's?
Rick Pitino has got them playing really well heading into the tournament. I always like to go for a nondescript team that's not, but still has a high enough seed that they can make it, but not one of the key favorites, because if my team wins, I usually have a decent chance of winning my bracket pool. So St. John's it was this year for me.
I think Sam got there. I mean, it looks like a second or so before Charlie did. So congrats to Sam. Just goes to show you, if you first don't succeed, try again, and Sam totally did. So thanks so much for joining us today. Really appreciate your time. And if you want that IVAS World Report or a valuation demo, Valuations as a Service demo, scan the QR code and we will be in touch. But have a great day, everybody, and we'll see you on the next webinar.
Thank you.